Hi there, and thanks for tuning in for another episode of Ask Spurrell CPA. I'm here with Tyson, and we're discussing buying the right franchise. So, Tyson, thanks for volunteering in the morning meeting there.
No problem.
How was your Christmas?
It was great. Had a good time with family.
Yeah, you just stayed in town here?
Yeah, and a little bit out in Hinton.
Okay.
With my brother. So.
Your brother's in Hinton, yeah. Mm-hmm. So the quote that comes to mind when buying the right franchise is the Michael Gerber quote, the author of The E-Myth. It says, "If your business depends on you, you don't own a business, you have a job. And it's the worst job in the world because you're working for a lunatic." A lunatic being you, of course. So the statistic that we always go to is that 50% of all businesses are out of business in 5 years. But there's some stats that suggest that only 14% of franchises go out of business in 5 years. Now that sounds pretty good, but 14% is still 14%. If someone told you, there's a 14% chance if you drove your car home through a catastrophic car accident, you might think twice about it. And business, going out of business is kind of catastrophic. So the story that we have here, 3 women came to us, once upon a time, thinking they had a can't miss pizza franchise business that they were going to buy into. And we dug through the information, and after digging through the information, we found that the franchisor was going to charge a royalty fee that was higher than they've charged any other franchisees in the past. And once we applied those numbers and we applied them to the locations that we had financial data for, we found that the franchise, there was just no return on investment that was worth the risk, effectively. Margins are pretty small in the restaurant business, and a few percentage points makes all the world a difference. So you have to be careful when buying into these franchises. So what do you think of the questions that these potential franchise owners should be asking, Tyson?
First, I would say, should you ever consider one franchise without comparing other franchise options?
I don't think so. And I think it's the number one thing that they all do. We always get these, business owners or prospective business owners that come into the office and they put the franchise information on the table. They're basically saying, this is the one I want. And they haven't really spent a lot of time looking into any other options. It's kind of like buying a house. And imagine if you bought a house and you only looked at one other house. Well, of course that house looks good to you because the only other option is being homeless. So it looks pretty good. But, when you're buying a franchise, there's so many franchise opportunities out there. You owe it to yourself, to look at multiple. And I would say you should have at least 3 considerations in any choice when you're deciding to buy a franchise. You should have a short list of 3 that you're working from and really being, objective in that analysis.
Mm-hmm. Next, I would wonder, do the people giving you the franchise information get paid to sell you the franchise?
100%. That is their job. They get paid to sell more franchises. And if you buy, they make money. They don't necessarily get any more money if you succeed. Mm-hmm. They only get, usually the person you're talking to who's selling the franchise gets money if you buy the franchise, which is a little bit unfortunate, but that's usually the way it's worked out. So they're not a business advisor. They're a salesperson, and you should proceed with them accordingly. That they are someone who gets paid a commission only if you buy. So their motivation might not be the same as yours.
Okay. Should you wait until buying the franchise to do a business plan with the franchisor?
No, it'd be like starting a business without a plan. So now, and this is what they tell you, hey, you plunk down your money, plunk down your deposit, and we'll work through a business plan with you. But by that time, the decision's already made. So what if you don't like the business plan? What if the numbers don't come out the way you want it to come out? Now you spent your money, you signed off on the document, you probably signed off on a lease, so you're past the point of no return here. Waiting, you need to do a business plan before you make any commitment to the franchisor to see if this is right for you. Okay.
Do franchisors often create a false sense of urgency when selling the franchise?
Almost every time. Almost every time I get a potential franchisee looking for advice, it's this frantic call saying, if they don't buy this franchise this week or next week, the opportunity is going to mysteriously evaporate. This franchisor has been trying to sell the franchise location for a couple of years now, and they want to sell as many franchise locations as possible. But if you don't buy next week, someone else is going to buy it. And they're always working off a list. Yeah, they have other prospects, but I'll go back to a real estate offer. I mean, how long does a house normally sit on the market, right? and there's a huge supply of potential franchises to purchase. So it's a very common sales tactic that these franchisors will deploy is we have very serious other purchasers who want this location. If you don't move this week, we're potentially not going to sell, even though they've been trying to sell that franchise location for a couple of years. So sure, they do have other prospects, but are they serious? Are they going to put down money? Or are they going to take some time to make a good decision as well? So I would, not use that as a mechanism to not make, good, prudent decisions and do some analysis.
Okay. Next, I would wonder what size of loans would have been issued based on notice to reader statements.
So, I mean, you can get loans as it applies to franchises. The Canada Small Business Financing Loan is usually pretty attractive. So we're looking at usually $350,000 for the leasehold improvements and the equipment. And at that point, we can get those on notice to reader financials, pretty good. So, usually we're looking at that limit for a new franchise, unless you have some collateral that you can put up yourself, or if you have a history of success in it. Usually that's the cap that you're working with, is that $350,000 for the hard assets.
Right.
That the bank's gonna help you out with if we get a favorable banker. So that should be the limit that we're looking at here.
Okay. Why is it generally a good idea to get financial data for more than one location?
So usually the franchisor is going to supply you the locations that they want you to see. Mm-hmm. And it's I always find it pretty curious about the ones that they don't want you to see, because you want an average, right? You're not necessarily you're going to expect the worst, but you also shouldn't expect to be the top performer as well. It's nice if you are, but you should be able to succeed on an average franchise. So what I like to do is to see the locations that they provide, and then you're just going to do a Google search and see what other locations are kind of common, and ask for some of the locations that they haven't provided. Let's see the data on these. How are these locations doing? And then we can start to get a good average of how your location is likely to do and what the progression of that location is too, because it's not just the location, it's how many years it's been around. A location normally for 1 year is going to look a lot different than a location who's 5 years in, right? So we want locations with number of years.
Okay. Should you contact franchise owners or existing franchise owners on your own?
100%. Don't just look at the ones in the franchise documents. Sometimes they'll supply you with contact information for existing franchisees. Go right to Google Places. Call them up. Hello, I'm looking to speak with the franchise owner. I'm looking at buying a franchise. Talk to the ones that they haven't supplied you the information. Those are going to be the least prompted responses. They're generally going to give you honest responses, because people are normally they're good like that. Other business owners, other franchisees, they have no motivation. If anything, they probably want to keep you out, so they're going to be pessimistic if it's really working out well for them, because maybe they want another location. But they don't have a lot of motivation to hide the bad stuff that's going on, especially in a phone call or an in-person meeting, even better. So don't just rely on the information they give you. Call up, talk to the other franchisees.
Mm-hmm. What's the difference between plain paper and accountant prepared financials?
So generally in these franchise disclosure documents, you're going to get plain paper documents. So there's no involvement from an external accountant. These are really just the internally prepared financials. And a lot of times they're incomplete information, and they change subject to year end, just like there's always adjustments at the year end. So they're not quite as reliable. It's a good idea if you can try to request, external accountant prepared financials for the various locations, and you can start to get a little more completeness. Often we have, entire categories of expenses that are excluded in these plain paper documents. When I say plain paper, I mean, they're just internally prepared. There's no external accountant who's, sign their name to this document in a notice to reader or review engagement report. So it's a good idea to ask for the external accountant prepared financials, because they're generally more comprehensive and more complete than the internally prepared ones.
Okay. How can a CPA help you test the reasonability of the numbers?
So we're going to go through, we're going to start to calculate it. Just like the exercise we did with those 3 women, we didn't just take the numbers that we gave. We read the franchise agreement and applied the royalty against the revenue. And of course, we came up with a completely different number because it was a completely different royalty expense. But often there's, other categories that they're going to, forget about, what the utilities are going to be in this place. We're going to read the lease agreement that's proposed there. Do the common area charges make sense? Because not every lease agreement is going to be the same, even if it's the same franchise. It's a different landlord. It's a different property owner who's going to charge you a different rate of rent. So, we're going to go through those numbers, the ones that you might have forgotten about, and we're comparing it to, other files that we have. Is this reasonable based on other files where, most franchisees are looking at it from the experience of one or two businesses. We're looking at it from the experience of hundreds or thousands of different businesses, and do these numbers actually make sense, or are they overly optimistic?
Okay. Is the owner's time accounted for fairly in the payroll numbers from the franchisor?
Generally, it's not. So generally, you're not going to get a great indication of what the payroll number is, because there's going to be the owners or their family members who are not paid fair market rates who are skewing the data. An owner who's there at the store every day, who's working 7 days a week, who's only drawing a salary of $20,000 a year, you're not going to be able to replace that person. So it's really important to know, how much the owner is working in the business, and how much of that salary number that we're seeing there is actually on the owner itself. And you can kind of work backwards, how many staff you need on, what's the hours that you're open, and figure out, what's a fair rate for an actual manager to hire, and what a real payroll number is going to be. That's usually one of the exercises we go through, and it's one of the common accounts that's not right if you take the information at face value. And it's highly material. They could have the owner, their wife, and their 2 kids all working in the business, and none of them are showing up in the payroll numbers, and it looks like a great investment. But unless you have a team of 4 slave laborers, it's not going to be a good investment for you. So that's one of the things you look out for.
All right. If you want to customize too many franchise processes, is a franchise right for you?
Probably not. That's the whole value of a franchise, is they've figured out the systems for you. So rather than you trying to reinvent the wheel, you can just hit the ground running and hit the ground executing. Now, some people like that, and some people think they're going to like that, but in reality, they want to start from scratch. And now you're starting from scratch. So yeah, it gives you more flexibility, but that's going to take more time. So if it's going to take more time, why burden yourself with the franchise cost and the royalty fee if you're not going to use it? And it's the same thing if you don't want to use it, as sometimes it's just incomplete. So sometimes their training documents and their processes aren't, they're not good enough for you to completely execute. You're going to have to make stuff up as you go along, because they don't have processes for all the situations you're going to run into, like hiring or, restocking the shelves. So if you're going to deviate from the franchise processes, or they don't have processes to address the situations, I'd probably want to move on from there and consider, starting a business from scratch, or another franchise that, has processes that are more in line with the way you like to do business. Mm-hmm. So I think that's all the time we have here today on this episode. So, as always, feel free to leave any comments in the comment section below, and we'll address anything you have in any future videos. Thanks very much.